Hi, I'm Amy Ford, and I'm going to teach you all the basics for accounting for current liabilities. I often joke with my students that this area of accounting kind of feels like the potpourri or the miscellaneous category on a game show because there are so many different topics that relate to the accounting for current liabilities. So let's get started. Let's start by first defining liabilities. Liabilities are future sacrifices of economic benefits that the entity is obligated to make as a result of past transactions or events. Liabilities are obligations of the business. Liabilities represent something the entity owes. Notice how I did not necessarily say dollar amounts owed? Liabilities can be dollar amounts owed, but could also represent a service that is owed to a customer. Now in this video, our focus is on current liabilities. These are obligations that are due in the next year. The 1-year time frame is based on the balance sheet date. So if your balance sheet was December 31st, 2017, then any liability due in 2018 would be considered a current liability. Another way to understand current is that current liabilities are expected to be paid using current assets. Now, to review the debit and credit rules. Remember, the normal balance side for liability accounts is the credit side. So to increase our liabilities, we credit liabilities. When we reduce our liability, for example, when we pay the amount that we owe, then we debit the liability account to reduce the liability account. Here's a list of all the different accounts and types of current liabilities that we'll discuss in this video. As you look through the list, notice that the word payable is a key indicator that the account is a liability account. All of these represent obligations of the entity, and we will go through each example together. Accounts payable represents amounts owed to suppliers or vendors. Oftentimes, businesses order from suppliers on account. On account means that the goods are not paid for at the time the goods are purchased. Now, here is where your understanding of accrual accounting and GAAP can really help. Remember, just because we didn't pay for something doesn't mean it's ignored. We now have an obligation and owe the supplier. Here's a basic example of a transaction with a supplier. On March 1st, 2017, we purchased equipment for $5,000 from our supplier on account. We now owe our supplier $5,000. We record this $5,000 obligation in the account Accounts Payable. To record the liability, we credit accounts payable. These types of accounts payable transactions would have terms on the invoice, such as due in 30 days or due by the end of the month. Transactions such as this with our supplier are short-term, usually just 30, 60, or 90 days. Let's say we pay the supplier on March 28th. At the time we pay the supplier, we have settled our obligation. To reduce the liability account, we debit accounts payable. And since we are paying with cash, the credit goes to cash. Is what we've covered so far giving you a better understanding of current liabilities? I hope so. If you want to learn more about how to record these transactions for items such as payroll, unearned revenues, and warranties, then click the link below or go to glime.com and look for our free basic accounting course in the CPA free resources section. In the course, you'll find other great information on topics such as the details on how to record inventory and property, plant, and equipment, which can really help you in your financial accounting classes. So click below or go to glime.com to learn more.